Hi, everyone. Good morning. I'll give just a few seconds here for people to get in from the waiting room. Thank you so much for attending. Very excited about today's webinar. And we are going to make sure that we leave about 15 minutes or so, 10, 15 minutes for questions. And as a reminder for anyone who hasn't been on these webinars before, you want to go to ask a question, you want to click on that Q&A icon at the bottom, and you can type in your question and then we'll see it. We can get started. I just want to make sure if people can raise their hand, if they can hear my voice, see the screen, and see me. Making sure all the tech is working. Always a question mark these days, but looks like, yes, we're getting a lot of participation that you can hear me. All right, so what we're doing today in today's webinar is we're talking all about retirement, all the aspects of retirement, and we basically used a research report that JP Morgan puts out. They put it out annually and they update it on an ongoing basis, but it's basically called the JP Morgan Guide to Retirement. So the slides that you're going to see, the pictures, are all from the JP Morgan Guide to Retirement. And basically, it's extremely comprehensive. There were more pictures and slides in that report than made sense to put it in our webinar. So we pulled what we felt like was the most salient and relevant to kind of our client base. But obviously, as you know, this, like all webinars, this is for informational purposes only. Nothing constitutes, a solicitation. We encourage you to, any of the references that you see or the sources, we encourage you to check out those sources. If you have questions that pertain to your individual circumstances, please reach out to us directly, okay? So what we're going to talk about here is planning, right? Number one is planning for a longer life, all right? Or at least a longer life than you might expect. We're going to talk about spending in retirement and planning how to spend your time, allocation of time and spending of resources. We're going to talk about Social Security and making informed decisions on when to claim Social Security, healthcare costs, long-term care, taxes in retirement, and then we'll finish with some thoughts about behavioral finance and understanding loss aversion. So we got a packed schedule for you here. So retirement is a multi-factor optimization problem, right? There's not one, it's not, you have one input and one output, right? It's much more complicated than that. And we think that there's far too much focus from the financial services industry, investment industry. When you hear retirement, right, it's all about the numbers. It's the number side of planning. But the reality is that retirement is as much a qualitative lifestyle issue as it is a numbers issue. And so we want to make sure we have more of a balance. And we're talking about retirement from, okay, here's just the numbers, which is kind of what we did in the last webinar, right? Sustainable withdrawal rates from last month that you can go and watch. This is going to be more, it's going to still focus on the numbers, but it's going to make sure that you're thinking through and aware of the parts of retirement that are not just quantitative based. And we'll give examples of that. You want to, being intentional about decisions in retirement around what's your purpose, what's your meaning, how are you going to allocate your time. That often drives more contentment than just hitting your number. We also want to kind of break things apart in terms of what are you able to control, okay, and what are you not able to control. So you can see from this first graphic, retirement at the center, the things that are out of your control, from what I've seen, are the things that people worry and talk about and focus on the most, which is what's the market going to do, and what's Washington going to do around tax laws and policies related to retirees. Reality is, we vote, we can do our best to make predictions, but it's out of our control. Whereas the things that are in our control, like how much we're saving, how much we're spending, how are we allocating our assets, and in what type of accounts, what behaviors are we engaging in, are we still working, all those types of things. They may not be totally in our control, but they're at least somewhat in our control. And so we want to try to focus our attention on where we have control, and spend less time on the stuff that's outside of our control. And I realize that that's hard to do with the CNBC and the news cycle. It's constantly being put in front of you. These things are constantly being put in front of you. So you just have to really try your best to, not engage as much with that information. Longevity and retirement, right? That's probably one of the biggest things you need to think about first is, okay, well, the first part of this problem that I don't know is how long I'm going to live. So we have a humorous quote here from Warren Buffett's partner, Charlie Munger, who said, "Tell me where I'm going to die and I will never go there." And that it just goes to the point that there's this unknown of how long are we going to live. And people look at average life expectancy, but you got to recognize that life expectancy it's a midpoint, right? It's an average, it's not an endpoint. You have to complement or use in combination with life expectancy data, your personal family history and your personal habits. I think one of the stats that surprised us in this is if you make it to 65, either you or your spouse has a 21% chance of making it to age 95. And what this is saying in addition is that if you're both in non-smokers and in excellent health, however they're classifying that, there's actually a 46% chance that if you made 65, one of you will make it to 95. There's constantly, you're hearing about advancements in medicine and in science that's allowing people to live longer, right? Even if you're retiring today, over the course of your retirement, medicine is going to continue to improve. That is likely going to extend your life expectancy more than what you thought it was at the beginning of retirement. So your plan probably needs to last longer than you might think. And this has asset allocation implications, right? You're going to need some portion of your portfolio that's growing and maintaining your purchasing power over time. Well, right, a fixed income instrument's not going to do that. That's going to provide you with income today, but it's not going to compound your wealth over time. And so the point is, once you have some idea of, okay, that might be 85 might be where I think I'm going to go, but I need to plan to 90 or 95, you have a good starting point. And this is when we run our plans, as when we do planning with clients, we never stop it at life expectancy. We always take it to 90, 95, sometimes even 100 for this exact reason, right? Because if you just plan for life expectancy, if you live beyond that point, you kind of got a big problem, right? So plan for a longer life. The next piece is you want to plan how to spend your time in retirement, right? As you can see from this graphic, between basically once you get into your 60s, the amount of time you spend working shrinks, right? Pretty aggressively to your mid 60s and basically goes away. And more sedentary activities take place over time. But the biggest change is the time that you were working now is going to socialization, leisure, volunteering, exercise, all those types of things. And I think one of the big misconceptions amongst people who are, eager to retire, and it's wonderful, is that they're just so tired and stressed out from work that they want to be done with that. And if they're done with that, they'll be happy. And what the research has shown is that the novelty of this permanent vacation fantasy or honeymoon it does occur, and it lasts several months to several years, but eventually you kind of reach a new base level of expectations and satisfaction, and it wears off like most things. And for people who haven't given any thought to how they're really going to spend their time in terms of alignment with their goals and their purpose and their values, there is a lot of depression and anxiety and stress from the void that is left when you're no longer working, right? People underestimate, they focus on the stress of their job and their work, which I get, but there's a lot of things about your job, like your identity, the structure of your day, your socialization, right? You're socializing with people, right? And they don't realize how much they're getting from that. When all of a sudden that's gone and they can't just go back and get another job, that really can shake people, right? And that's why it's ranked as one of the most stressful events. You need to respect retirement as being, it's an exciting time where you're going to be able to essentially have a lot of freedom and enjoy everything you want to do that you haven't been able to do, but you need to respect the fact that it will be stressful and there will be things that occur that you don't expect. So JP Morgan uses an acronym basically called PUSHES to help guide people with this non-retirement side. But there's a lot of other things out there that we can talk about with you. But having a sense of purpose, right? Using your time to help others or to do some part-time work, volunteering, socialization, healthy behaviors, exercise, expressing gratitude, focusing on strengths and abilities, all of these things are incredibly important to having a fulfilling retirement, having an engaging retirement, all those things that really that get left out when you're just looking at the numbers. The other thing you have to prepare for is you may end up retiring earlier than you expect, right? Most people, when asked, you can see on the graphic on the right, expectations of workers versus retirees. So if you ask workers, what are the chances you're going to retire at 65 or older? 69% say, yeah, 65 or older. But the reality is most actual retirees retire at about 62. So there's, and that could be for a variety of reasons. It could be at the employer level. It could be a family health event. It could be the worker, him or herself, who is no longer able to make it to be able to work the way they used to. So yes, many of you will make it to 65 or even longer, but you need to start planning once you get into your 50s of, if I'm only able to make it to 62 or 63, how does the plan look then? Social Security. So Social Security is, one of those big retirement issues that everybody has questions on. It is an incredibly complex system, right? It's essentially the government, it's a US pension for everybody who's worked in America, right? And it's a really important part of your retirement income that, a lot of people discount. They say, oh, it won't be there. Oh, it's way lower than what I'm going to need. All that may be true, but the reality is it does have a meaningful impact on retirement, and it plays a very important role in helping to address your fixed expenses in retirement, not necessarily the travel, the home improvements, all the discretionary things, but the stuff like your rent, your utilities, your insurance. It goes a long way to meeting those expenses and doing so in a way that doesn't have any market volatility related to it. Okay, so it is a very important part of the equation. Now, this graphic looks a little bit overwhelming, so we're going to break it down. Okay, there's something called full retirement age when it comes to Social Security, and that's the age at which, if you reach this age, you're going to get 100% of your Social Security benefit, which is listed on the Social Security statement. You can find it online, or it's mailed to you every 5 years. If you were born in 1954 or earlier, the full retirement age for you was 66. Every year thereafter, 1955, okay, 1956, 57, 58, 59. From 55 to 59, the full retirement age is extended 2 months at each of those increments. So 66 for 54 earlier, then it goes to 66 in 2 months, 66 in 4 months, and so on and so forth, all the way till you get to 1960 or later as a birth year. And then your full retirement age is age 67, right? So they're trying to, this was put forth back in the early 2000s as a way to help shore up the Social Security system by essentially delaying when people could get their full benefit. But beyond that kind of basic, that's the full retirement age, you do have an option to take it earlier than 60, your full retirement age, or take it later. And there's consequences to doing both. Most people, for whatever reason, they're anchored, right? The behavioral bias, they're anchored to 62 because that's when they know, they've been told, I can get access to Social Security. And so many people do take it early. They take it at 62 because that's when they can get it. Now, as you can see, the amount that you get at 62, as shown by the dark gray circle, is 75%, okay, of your full benefit amount if you're born in 54 or earlier. You can look at the year of your birth, okay, here, and then look here to say, okay, here's the amount I would get of my full benefit if I took it at 62. And then for people who are born in 1960 or later, if they take their benefit at 62, they're only going to get 70%. So it's about 6% per year average decrease for each year you take it before full retirement age. Okay. Now, let's say you say, well, no, I'm not going to take it at 62. I took this webinar. I understand longevity risk. I'm going to delay the benefits for longer. You can do that as well. So if you do that, for every year you delay, there's an 8% increase in your Social Security benefit on top of any cost of living increases that Social Security income gets. So if you're born in 1954 or earlier, you actually get the benefit of 4 years, 8% each year, which would mean that your benefit amount is 132%, or at least, because you also have the COLA increases, 132% of your full retirement benefit. And for people who are 1960 or later, it's 3 years, 8%, so it's a 24% higher benefit. It's hard to know. I think people conceptually know, okay, well, that's a lot, and I can't get 8%, as a guaranteed return in the market. But this is really an issue of the cash flow, right? If you're taking Social Security early, you're getting that cash now. If you don't take Social Security, you got to find a place to pull that money from, right? So this is kind of the balancing act. So really what we want to think about is, okay, if I took it early, at what point, or excuse me, if I took it later, at what point would I overtake, right? And what year would I overtake my cumulative benefit amount relative to taking it sometime earlier? And that's really the question. And if that's, really far out, then you might say, you know what, that's not worth it for me. Or, there's no, my health situation is such where I'm not going to live into my mid to late 80s. So I'm not going to worry about that. I can take it. That's fine. But you don't want to just think about it from your perspective. You need to think about it from your perspective and your spouse's perspective. Because if we go back to that slide I showed earlier, we know there's a decent chance that at least one of you is going to make it to late 80s or 90, right? If you've made it to 65 already. And so the way Social Security works is when one spouse passes, the surviving spouse will keep the higher of the two Social Security benefits. And that Social Security benefit will last for as long as that spouse lives. So one very effective strategy is to take the highest income earning spouse and have them delay their Social Security to age 70, so that whether that spouse passes or the other spouse passes, whoever's the remaining spouse will hold on to this maximum Social Security benefit, which is cost of living adjusted, for as long as they live. And when you're talking about expenses in retirement, the unknown of expenses and the unknowns around market volatility, having the highest amount of guaranteed income that you can for as long as you can becomes incredibly important. Okay. So, that all sounds good, but what about the numbers? So here are the numbers. Retirees often underestimate the power of that survivor benefit, which is what I just mentioned. And we know that there's roughly a 1 in 2 chance that one spouse makes it to age 90 if both spouses make it to age 62. And so the way to look at this break-even analysis that JP Morgan did was, if you claim it, and this is just for illustrative purposes, but the amounts are going to be roughly correct for someone earning the Social Security limit for most of their career. If they claim at 62, they're going to get $25.57 per month. Okay. If they claim at full retirement age, they're not going to get it until 60, 66 or 67, but they're going to get $36.53 per month. And if they wait till 70, they're going to get $45.30 per month. So you can see, right? Look at the difference between the monthly income at $2,500 a month versus $4,500 a month at age 70. It's a massive difference in income, and that goes for a long time. So if you say, nope, I can get social at 62, they're offering it to me, I'd be crazy not to take it when I can get it. And that a lot of people have that logic, so they take it. So here they're taking it, they're going along, going along, going along. But their friend Bob down the street says, you know what? I'm going to wait till my full retirement age to take it. So they're not getting any income here, but they start at 67. So now they're going along and getting their social, and their Social Security, this is cumulative amount over time. You can see it starts to get bigger. And by time they get to 77, the full retirement age approach in cumulative benefits exceeds the amount if you took it at 62. And if we go a step further and say you're really delaying their gratification, and they wait till age 70, right? They're not taking it till here, so they're behind, right? But the amount that's coming in is higher. So by time they're at age 77, they're kind of closing in. They're at 495 versus 547, 551. But by the time they get to 81, they've overtaken both of the previous strategies. And this is that longevity insurance component, right? I mean, it's hard when you're 62 or 65. They go, I'm going to be in my 80s. I just hope I'm alive. But there's a good chance you will be, and there's a good chance costs will not be lower. And so you can see that it overtakes it in about 81. And at the end, if everyone lives till age 90, here are the cumulative amounts. So it's 1.77 million, 1.58 million, and 1.27 million for each of these the strategy of when you take it. So I think be careful not to underestimate the power of the survivor benefit. That survivor benefit is when you're both alive, you're going to be getting a Social Security benefit for both of you, or a primary and a spousal. But when one spouse dies, you only keep the higher of the two Social Security benefits. Okay. And that's where we believe that delaying as close to 70 as possible makes sense for so many people as a result of that. Spending in retirement. Okay. So the way financial plans are modeled, and the way we model them, is basically we take your living expenses pre-retirement, and for the most part, there's some modifications are made, but for the most part, we extrapolate that at a 3% inflation rate over the course of retirement. But the actual research has shown that spending in retirement more resembles kind of a smile, as you can kind of see from this chart, where certain expenses will go up, like healthcare, but many expenses will actually go down. And you can see from this chart, this is data followed by JP Morgan Chase. You can see annual average, right? Average household spending by age. So not everyone's going to follow this, but you can kind of see it dips from 115 to the first few years of retirement all the way down to about 86,000 by the early 80s. That's kind of where it troughs, and then it gradually goes back up. Sometimes it can spike up at the end of life because of healthcare costs. But it is definitely something that you want to factor in, is that even though there could be this fear, oh my God, there's no way I can retire based on what I'm spending. Spending actually, it will change, right? The categories will change, but over time, kind of in the later years of retirement, you will most likely, at least if the averages are any indication, will spend less than you might think. Okay, and this is something that's important to factor in, and it doesn't apply to everyone. This is kind of a more simplified chart that I think does a good job, right? So kind of between 65 and 75, you're in the most active phase of your retirement, called the go-go phase, right? And you're spending basically everything you're spending while you were working. And then once you get to 75, there's a little bit slower, right? Tend to be a little bit more sedentary, not going to do the same amount of travel maybe that you used to, not as many trips. And so there is this reduction in spending. And then from 85 on, your typical expenses will continue to decline, but the unknown is kind of the healthcare, long-term care piece that can create a spike in spending towards the end of life. But in general, healthcare expenses are going to increase at a faster rate than any other category of expenses in retirement, as you might imagine. So if you're thinking about this, and we can do, and from a planning standpoint, it's really useful. If we know that the withdrawal from the portfolio is going to be much higher than much higher during the first 10 years than the last 20 of retirement, we can allocate, right, your portfolio in such a way to support a higher level of spending early in retirement, knowing that there will be less reliance kind of in this middle section of retirement, and then making sure, you know, we have reserves for some potential eventual healthcare event or long-term care event. Okay. So healthcare costs in retirement, it's usually the biggest cited fear amongst retirees is what is the cost of healthcare going to be in retirement? And it's, you know, it definitely deserves attention. T. Rowe Price did an excellent piece on this that we read in preparation for today, which basically said you'll see these, you know, you'll see kind of news publications or think tanks come out and say, you know, the cost of the healthcare costs in retirement is $350,000 over the course of your retirement. You need to be prepared for that. And T. Rowe made the very astute point that said that's not helpful because your healthcare expenses are not going to come out in a lump sum fashion. In fact, when they actually looked at it and they broke down healthcare expenses, 77% of total healthcare costs, okay, was comprised of the premiums you pay. And those premiums could be your Medigap premium or your Medicare Advantage, if you go that route, your Part D premiums, your Part B Medicare premiums, okay? And you can see here the out-of-pocket costs for a typical 65-year-old was about 103 per month out of 516 total, or about, right, 20%. So it's much better to think of those costs of healthcare and retirement as part something that's going to be deducted kind of from your guaranteed income on a monthly basis, and then about a quarter of it, which is going to be lumpier and less predictable, which is going to be more the out-of-pocket. And I think that makes it much more of a palatable kind of statistic of how much healthcare costs are going to be in retirement. But it's definitely something that you need to take into account. And you have to take into account that the cost, the inflation on healthcare expenses is likely to be much higher than the overall inflation. JP Morgan's is predicting a roughly 6% per year inflation rate on healthcare costs in retirement. Most of that is somewhat predictable because it's in the form of premium, so it's each month, but there is a component that would be variable and lumpy, like the out-of-pocket expenses. Another thing many of you have unfortunately dealt with is this income-related monthly adjustment amount. It's called IRMA. It's a surcharge that Medicare imposes on your Medicare Part B premium, depending upon your modified adjusted gross income from 2 years before the year that they're looking at. So if you sign up for Medicare in 2023, your Part B premium will be related to what your income was in 2021, which they look at from Social Security records. That income amount is inclusive of your required minimum distributions, right? So there are tax planning opportunities to try to minimize these surcharges. If you retire in your late 50s or early 60s, you have a window of time potentially between then and 65 where we can do Roth conversions, or you can withdraw money out of your retirement accounts while staying in a low tax bracket, with the idea that you're trying to reduce the requirement of distributions you'll have to take once you reach age 73 or 75. But you can see here, it is material, right? Married, filing jointly, there's about $168 per month you pay as a Part B premium, and these are on top. So per person per month. If you're in this bracket, 194 to 246, an extra 78 per month per person and upwards. So by time, if your income is really high in retirement, again, yeah, good problem to have, but your healthcare costs are going to be much higher because of the Medicare Part B premium. The Part B premium, if you're taking Social Security, it will be deducted directly from that. If you're not, it'll be something you have to pay out of pocket. Another kind of related healthcare item is long-term care planning. So long-term care planning is related to expenses that you might need or around custodial care, right? You're still doing fine, but you may have cognitive declines or physical declines where you're not able to do all the things that you did when you were younger. And so Medicare covers a very tiny temporary portion of long-term care expenses. It doesn't do anything in any material way. A lot of people are mistaken and they think, oh, I have Medicare, I'm covered for a long-term care event, but that's not true. The other thing is that long-term care is not just a financial problem, it's a logistical and emotional problem too, right? Especially if there's only one parent left. You got to figure out where you're going to put mom and dad, what type of home, do they want the care in the house, who's going to provide the care. If it's a family member providing the care, they need to be aware of all the kind of dignity issues that go along with caring for someone who isn't able to care for themselves. And a lot of that is just people are not prepared for that from a mental and emotion standpoint, let alone financial. So you don't necessarily need long-term care insurance, but you do need to have a long-term care plan. When we go through planning with clients and we're people who are retired or looking to retire, we always look at a major long-term care event happening in retirement to stress test the portfolio to make sure that the plan will still work. And sometimes the plan works, but it has a dramatic impact where we need to talk about kind of other alternatives. But you can see here, lifetime cost of care for people 65 and older, if paid care is used, the majority of people, it's going to be less than 75,000 out of pocket. There are going to be a group of people where it's more substantial, but then there's kind of this 1 in 3 chance or 30% chance that the costs are greater than 250,000. And that's almost always related to some sort of prolonged physical impairment or cognitive decline, dementia, Alzheimer's, things like that. And it can happen, sadly, and it can go on a long time, and it can be quite expensive. So other interesting things to note, providers of unpaid care, half of the time it's an adult child. And what you have to recognize about that is not, you got to look at your situation and see whether that's even a possibility, right? If your adult child has their own family, their own life, their own job, how realistic is it that they can give all that up, surrender that, and come and take care of you? It may be doable, but it's probably not realistic for many people, particularly if the child lives, not in the same area as you. Duration of paid care, if paid care is used, you can see, right, there's predominantly it's 5 years or less, but there are those occasions where it can last longer than that in the event of a, more of a cognitive type of decline. So what are some options around long-term care and how to pay for it? Well, obviously, if we test the plan or stress test the plan and it shows you have enough money for it, that's basically saying, look, you're going to be you're self-insuring is an easy way to look at that. You're self-insuring, you're going to use your savings that you've accumulated over your life, and you are going to have enough of a buffer where that will go towards paying the cost of care. That's not as simple as it sounds, because most people don't want to spend their own savings on paying $15,000, $20,000 a month, but they may not, if they don't do any other planning, they would not have a choice. Some people say, I'll move in with my son or my daughter and they'll take care of me. We kind of talked about the issues with that. Other options are purchasing some sort of insurance to offset some of the costs and get some resources like a care coordinator that insurance companies provide to decide which is the best form of care for your situation. That could be, so this could be traditional long-term care insurance, life insurance with a long-term care rider, annuity products, those types of things. Life plan communities, also known as continuing retirement care communities, popular versions of this in this area are a good place like the Goodwin House in Northern Virginia. So, right, you sort of are buying into this community where you can live independently, but if your needs escalate, everything is there and available for you. Another option would be, utilizing your home as a source of funds, whether it be selling a second home or using the home equity in your residence through some sort of line of credit. There are, some people choose if they really want to stay in the home and that's really their goal, is to stay in the home and get care. They could look at something like a reverse mortgage. I know there's a lot of bad press about those, and for good reason. They can be very expensive and people don't understand how they're being sold, but they can play a role to fulfill a need in the right circumstance. And then after exhausting all options, if all savings are drawn down and income is being used and there's nothing left, then the government will step in. So it's Medicaid essentially takes over. But that's not a place we want to shoot to go, but it's there as a backstop. So tax considerations in retirement. This is really meant to go through and explain, when you pull money out of different types of accounts, there's going to be different tax implications depending on the type of account you pull out. One thing that doesn't get talked about as much as it should is a health savings account. So a health savings account, or an HSA, is something that's normally tied to your employer health plan, and you have the option of putting away money into your health savings account and investing it on your own for future medical costs. And it is the only type of account that goes in pre-tax. Any earnings or interest or gains grows tax deferred. And when you withdraw money out, as long as it goes to qualified healthcare expenses, it actually comes out tax-free. So you get a triple tax-free benefit with a health savings account. And what I've started to do as of this year is, before I was putting money into a health savings account and then I was just taking out throughout the year to pay for healthcare expenses. But I'm changing my strategy. As a result of all this retirement research and just thinking about it, what I'm going to shoot to do, just to give you a sense, and this is personal for me, but is to still put into the HSA, but to pay for as much of my healthcare costs, not from the HSA, but just from cash flow, with the idea that that HSA then will be used way further down the line when I need it for healthcare expenses, in retirement, or just if something pops up. It's a way to get a lot of money in an account that has just very special tax advantages for an expense that I feel very confident, and I think this would apply to most people, that's going to be a material expense at some point in my life. I hope not for a long time, but that's my thinking. So I'm essentially giving up some cash flow now in order to defer it into this type of account to get extra special tax treatment for medical expenses specifically. Okay. The next best thing is a Roth IRA or a Roth 401k. Why? Because any money you withdraw out of those accounts in retirement, as long as you've had the account for 5 years, will be tax-free at a state level and at a federal level. Now, the next type of account is a taxable account or a brokerage account. This doesn't show it here, but a very important part of this account that you need to remember is there's some amount of this account that's actually your cost basis. So if this total account, let's say this whole bucket was $1 million in a taxable account, your cost basis might be $500,000. So now you have a $500,000 worth of gain, right? But it won't be uniformly distributed. Some positions will have higher gains, some will have lower gains. So you can manage this account by selling certain things, buying other things, right? But managing the allocation to actually extract money very efficiently out of this account so that you're paying very little in taxes and getting the best bang for your buck in terms of the amount of money you're taking out and you can spend. To the extent it's a taxable event that occurs in the account, such as dividends or interest are generated, or you do sell something that's a capital gain, you have a realized capital gain, you will owe income taxes on that. And it will factor into what percentage of your Social Security is taxed and whether there's Medicare surcharges. You can see here with these distributions, it currently does not factor into that, which is nice. So I just want to make that point on a taxable account, because if you're just looking and say, oh, well, if I invested in tax exempt interest like municipal bonds, I'm avoiding taxes at the federal income level, potentially at the state. But this doesn't paint the full picture that you can sell from the taxable account and your taxes, it's not going to be like you're taxed on the entire amount of what you withdraw, because some portion of it is going to be your cost basis. Okay, so this will vary person to person, account to account, position to a position, but it's really an important part of the withdrawal strategy in retirement is taking income, right? Taking money, withdrawing it from this taxable account in a tax efficient manner. And the worst place to take money from in retirement, purely from a tax standpoint, is your pre-tax 401k or IRA, because all withdrawals are taxable as ordinary income. Of course, this is the best place, or the next to the health savings account, best place to put money in while you're working, because you're lowering your tax liability and you're getting the benefit of tax deferral on the gains for a long period of time. But in retirement, it is not. It's something that's actually kind of a thorn in your side, because any money you take out of that immediately shows up as ordinary income. It's factored into how Social Security is taxed. It's factored into your Medicare surcharges. It can hurt you on the deduction side. I mean, there's all sorts of reasons. So for most people, their income is higher in retirement than once they're retired. And so the pre-tax route makes sense, but it does come at a cost. And the cost is that all of that money you pull out is taxed as ordinary income in retirement. This is another kind of slide showing it's similar, right? It's tax considerations in retirement. Where you pull the money from in retirement matters, right? The ordering of it, how much you pull out of a particular account, it matters, because we have a marginal tax rate system. Well, what does that mean? It means that the more money you make, or the more money that is considered income on your tax return, the higher the tax rate you're going to pay, right? So if you're taking out a small amount of money, it might be taxed at 10%. But if you have a pension and social, and you're taking money out of a 401k account or IRA, it could all of a sudden be 22 or 24%, right? That it's being taxed. So you have to be very aware of the types of accounts you have and the types of investments in those accounts. And you want to look at your distributions, right? Your retirement income distributions and tax situation over more than 2 years, right? You don't want to just look at the next 2 years, because that might be missing a big opportunity where, boy, I have 6 years before I'm going to have to start taking requirement of distributions. Now is my window to really make these assets and my income as efficient as possible in these other accounts. So you can see here, I'll focus really on the withdrawal piece, but it's just showing that the minus is subject to taxes, the plus is preferential tax treatment. Pre-tax 401k, right? Withdrawals are taxed as ordinary income. Roth IRA, Roth 401k withdrawals are not taxed. And then if you have a taxable account or a non-deductible IRA, you're going to have some benefit of the fact that some of it's cost basis, but gains will of course be taxed. And then for health savings accounts, as I mentioned, you get the triple tax-free treatment for qualified health expenses. So it's an unusual. This is a very useful and unusual account for retirees. Okay, now let's move on to kind of behavioral psychology, using behavioral psychology to your advantage. You know, people, even though you might have one big pot of money that you consider to be your retirement money or your assets, when people go to actually think about spending that money or are looking at that money, they generally mentally account for this money is for this purpose, this money is for that purpose. And that's fine. In, you know, kind of pure rational economic theory, they would say, well, all your money's fungible. It doesn't, you know, you can mentally account for it however you want, but it doesn't change the fact that what you have is what you have, and you shouldn't think of it that way. But the opportunity from a asset allocation portfolio construction standpoint is, because we naturally as humans do think that way, we can structure our portfolio based on how we mentally account for things. So shorter term goals, medium term goals, and longer term goals, right? So the shorter term goals would be kind of your emergency reserve, a car, or an expense you have coming up in the next year, and that's all in cash and cash equivalents. And then over more of a 5 to 10 year time frame, could be something like paying for college or buying a second home or just meeting expenses early on in retirement. You have the majority of it in fixed income bonds, right? Paying a fixed rate of interest, and the remaining amount in stocks. And then for anything 15 plus years out, okay, so things kind of down the line in retirement, healthcare, potential expenses, long-term care, some sort of gift you want to give, that you could have, right, majority towards long-term growth assets like equities and a smaller majority towards bonds. So you're essentially aligning, right, your investment strategy based on the goal and the risk level, right, the goal and how long the goal is out. And I think this is a very helpful framework for many people to think about, their asset allocation, retirement, and not being as concerned, right? Because when people lose money on paper, normally it's from this blue section, the equities. Not always. Last year was both bonds and equities, but normally it's equities. And if you can kind of remember, well, okay, yeah, I've lost money on paper, but that's stuff like, think about 15 years ago was the great financial crisis. So a lot of stuff has happened since then. A lot of the concerns have kind of gone away that stem from that crisis, like whether people's accounts were going to go to zero or not, right? Market's significantly higher now. So when you're thinking out, you can't even think out 15 years. It's so far out that it's very hard to think out that far, which is why you can look, again, it's historical. There's no crystal ball, but for looking from 1950 to 2022, and you're looking at just stocks, right, over a 20-year rolling period, the worst performing per year return in stocks was 6% per year. So the longer you go out, the greater the chance, right? It's probabilistic, the greater the chance of positive returns, which is why, 15-year time horizon and longer, you shouldn't really be worrying about that on a month-to-month, year-to-year basis in the portfolio. I know it's easy to say that, and then when you're looking at your accounts, but if you can use this as a framework to remind yourself, well, this isn't money I'm going to even need until 2035. I probably shouldn't worry about it. I would agree. And then aligning your type of spending with corresponding assets and income. There's a good analogy I heard recently where, the accumulation phase of retirement is kind of where you're climbing the mountain. And when you retire, you're kind of at the peak. And the retirement or decumulation phase is making sure you get down that mountain safely, on time, right, and not injured. And that decumulation phase has it is very different from the accumulation phase. And the reason is, when you have volatility in the markets during the accumulation phase, as long as you don't panic and you can continue to add in, it actually works to your benefit because you're putting money to work when the market's at lower prices. And it doesn't have an impact on what the eventual amount's going to be. But when you're pulling money out in retirement and need retirement income, it definitely plays a role. That market volatility can play a huge role and can, if not managed carefully, can result in you exhausting your assets before you're gone. And so one thing that we are really like and encourage, and there's been a lot of research on this, is as much as possible, to the extent you have fixed expenses, right? Stable spending versus variable spending, is looking at, okay, what are my fixed expenses, and trying to tie those or map those or match those to guaranteed sources of income like Social Security or your military retirement pension or some annuity that you have. And the reason is because if you can match expenses that are going to occur every month with income that is coming in every month, it makes you much less reliant on your portfolio to take money out, right? Because you need to take it out to pay for these fixed expenses when markets are down like they are now. And so kind of trying to map, and it's not going to be perfect, right? But mapping guaranteed income sources to fixed expenses has been shown to be a very effective strategy. And this is kind of showing that you can, the income that would come from dividend paying stocks or fixed income securities or multi-asset solutions, rental income could feed, right, your stable fixed spending, and it also could feed some of the variable spending. Above that amount, right, for variable spending, you want to have some amount in cash or cash equivalents to meet those expenses. And then kind of above the combination of variable spending and what's going to be left behind, you need to have some assets that are more growth oriented, right? And the reason is because when you're 15 years from now, the stuff that's growth oriented is going to kind of fall into more of this fixed income, maybe even dividend paying, and replace some of the variable spending needs or even stable spending needs that have gone up because of inflation that not all of your fixed assets could handle. So very useful framework in our opinion. And one of the best exercises you can do before and periodically in retirement is to categorize your spending between those fixed stable spending expenses and the variable expenses like travel and home improvements. It helps a lot to minimize your reliance on stocks to do the heavy lifting to meet expenses month to month, right? Which we kind of established. You don't want to have all of your money in stocks and then be pulling from it every month in order to meet, expenses you have to pay, your rent or your mortgage, your insurances. And using this framework, I think, does help to inform intelligent, strategic, long-term asset allocation. All right, I know we have questions. It's our last slide here. All right, very important in retirement to keep this in mind, that we as humans are naturally loss averse. What does that mean? You can see here, losses hurt more than gains feel good. In fact, it's a 2-to-1 ratio. It's a 2-to-1 ratio. And I think everyone who's listening here can attest to when they see their accounts going down, it feels way worse than the pleasure you get from when they go up. And just that reality is hard in general as an investor, but it's doubly hard in retirement because the psychology of retirement is I'm no longer working, I can no longer replace these assets. And that's true. But it can lead to some very poor decision making. Daniel Kahneman, who's arguably the father of behavioral finance, has a quote that's very relevant, and that is, the more emotional the event is, the less sensible people are. Okay, and it has everything to do with, right, our brain psychology, fight or flight. When we're in a fear-based, stressful scenario, we lose sight of the fact that the world is still probabilistic, and we just assume when things are bad and we're afraid that the worst outcome is going to happen. It is definitely going to happen, and we make our decision based on that. And so often the worst investment decisions occur when the markets are at a low. Why? Well, the markets aren't at a low when everything's going hunky-dory. The markets sell off and are at a low when things look really bad in the world. Something's very broken, right? Whether it was the COVID lows or when the Fed rate, skyrocket interest rates and inflation came in much higher than expected for longer than expected. All these things result in market volatility, market uncertainty, and sell-offs. So here's the stats, okay? And I think this is important because a lot of people would argue with this statistic and say, well, this might be true, but if I avoided the 10 worst days, I'd be way better off too. Yes, but there's asymmetry between the likelihood someone's going to get out of the market when it's going through the roof is much, much less because they're not worried at all. They're making money. They want to make more money. And we've seen that bear out. And then here in this scenario, it's at times when the market is in a very bad state where people bail. And so this shows if you stayed fully invested from 03 to 2022, this would have been your rate of return. Invested 10,000 would have resulted in this amount of money. If you missed the 10 best days, your return would have been cut in half. This is over almost 20 years, okay? 10 days. You missed the best, and those 10 best days are almost always right in line with within 2 weeks of the worst 10 days. So I just know from experience, we had the COVID lockdowns, and as much as we can try to help people stay the course, sometimes they just can't take it, and they get out, and it doesn't mean the end, but it does mean it's greatly going to impact return, and that's what's happened. You can see the more days you miss, the worse your return suffers. So it's hard, but being aware, right, that we are naturally loss averse, and that we're most likely to make some of our worst decisions when things are at a low, can help you kind of take a pause and say, let me revisit the plan. Let me look at things big picture. Do I need to make changes to make sure I'm going to be okay? If the answer is no, then it's usually best to not react. Okay. So we're back to kind of the disclosure page which we started with. I see there have been 4 questions that have been submitted. Jeff and the team are fielding some of these, but Jeff, I don't know if you want to read them off, if some of them have been addressed but are still worth reading for everyone's benefit.
Yep. So let's go right in. The first question is, what income would make the full Social Security benefit? And I think that question refers to the Social Security wage base.
Yes.
Which for 2023 is $160,200. And that gets indexed upwards over time, kind of in line with inflation. So I think that helps to answer the question. Of course, the calculation for determining the max Social Security benefit is a little bit more complicated than just that. But I think that serves to answer the question.
Yeah, and you could go to ssa.gov/my-account. If you haven't done that, you should. You'll have to answer some identity questions, but pull up your latest statement and you can look through your earnings history and see what Social Security is saying your full retirement benefit will be. I think that's a really good starting place if you haven't done that.
I have a couple questions on long-term care.
Okay.
The first one is long-term care insurance worth getting?
So it depends. It really depends on your particular circumstances, what your income sources are, what your asset level is, what your risk tolerance is, your preference. I mean, obviously, obtaining long-term care insurance, the benefit is that it creates a pool of money that's available to you in the event that you have a long-term care event, then that pool of money would not otherwise be available, right, if you're self-insuring. The big downside of long-term care insurance is the cost. You might not need it, and so you're paying for something that you may never need, and it's not inexpensive, and the premiums can and have gone up over time to help make sure that the insurance companies can continue to pay your claims. As we said during the webinar, I think the most important thing is to have a long-term care plan, not necessarily long-term care insurance, although that could be part of it.
And I would just add, when we do financial plans for clients, we are always running those types of scenarios just to make sure that in the event they don't have long-term care insurance, their portfolio can withstand and whether or not they even need long-term care insurance. So yes, that's great. Sure. Another long-term care question is, how does the long-term care insurance impact the healthcare spend analysis? I think that was going back quite a few slides, but maybe you could. It's not
the healthcare costs analysis does not include long-term care. So that they're two separate things. The long-term care is not reflected in that healthcare cost specific graphic we looked at.
Great. And then I think if you want to skip back to the tax considerations and retirement slide, there was a question on RMDs from the various types of accounts. There you go.
Okay. Yep.
And which ones I think would be exposed to.
So you have to pay an RMD on You have to do an RMD distribution on these assets, these accounts, pre-tax 401ks, 403bs, traditional IRAs, and you have to currently take an RMD in a Roth 401k. But that's going away with Secure Act 2.0, where there are no RMDs on Roth IRAs, and there won't be on Roth 401ks either. I think starting January 24. But you could always roll your Roth 401k to the Roth IRA, and then you don't have to take the RMD. So in the same HSA, you don't have required distribution. So it's just this that has RMDs, or if you inherit an IRA from a parent, right, as a beneficiary, then you also have to take RMDs from something like that. I think that answers the question.
Yeah, I think that covers it. Next question. If I was born in 1956, when would I be required to withdraw from the 401k?
1956. So that's going to put you
73.
at 73, correct? Yes.
Next question on an HSA. Can you invest in HSA when you're retired?
Yes.
And does it have to be used up by a certain time?
No. Yes, you can invest it, and no, it doesn't have to be used up for a certain time. It cannot go, so it's a little tricky. Once you sign up for Medicare, you cannot continue to contribute to an HSA. And an HSA, I believe, cannot go to pay Medicare Part B premiums, but it can be used for, the other out-of-pocket health insurance costs, Medigap premiums. We'll get that exact answer on what it cannot be used for. But the answer to the question is yes. It can be invested and does not have to be taken out by a particular time.
Yeah, I think that was all the questions we had for today.
Awesome.
We can give it a second and see if there's any stragglers, but that was it.
All good?
All good. All good.
All right, great. Thank you guys for attending. As always, we continue to get really good turnouts to these webinars, so we will keep doing them. We'll probably do another retirement planning related one in April. And then in the summer, we kind of have a nice little surprise where we're going to bring on a market strategist from Fidelity. It's in the works, very knowledgeable guy. We've talked to him a fair amount over the years, but we continue to try to improve these webinars. So we're always open to hearing your feedback, but thank you so much for attending, and we will see you next month.